Welcome to lecture number 23. Previous lectures, if you remember, we did short-term debt paying ability. After that, we covered the topic of long-term debt paying ability. uh, in lecture 23, 24, and 25, we will look at we will do a critical analysis of the profitability of any company. Now, what is profitability? Profitability is the ability of a firm to generate earnings. Analysis of profit is of vital concern to stockholders because they derive revenue in form of dividends. Now, why is profitability an important aspect of any stockholders scenario? Because when these stockholders they buy stocks, they expect to earn profit on it. So जो आपकी profitability होती है company की, जो the profit that you earn, obviously you pay to your shareholders from that profit. Further, increased profits can cause a rise in market price. जितनी company profitable होगी, obviously उसके stocks की जो value है in the market, वो उसी तरीके से increase होती है. Or profit are also very important to creditors because when you are giving credit to any company, let's say a bank, so the banks look at the profitability of a company because profits can become a very important part of how you repay your loans, how you repay your credits. Management uses profit as a performance measure. Normally, rule of thumb is that the more profit you earn, the better your performance is. In profitability analysis, absolute figures are less meaningful than earnings measured as a percentage of a number of bases. The productive assets, the owners and creditors' capital employed, and sales. When we look at profits, so we normally use three measures to gauge the profit that any company is earning. One is the assets that you have, the productive assets. Productive assets are the assets, which can lead to productivity. Normally, when you buy assets, so the main aim of using any asset is to earn profits through it, is to increase your sales using those assets. The second is the owners and the creditors' capital employed. How much capital the owner has invested in the business, how much capital you have in form of creditors, लोगों ने कितने आपके stocks purchase किए हुए हैं. That is also a very good way to measure the profitability and the profit that you earn when you compare it against the capital that either the investor has invested or the creditors have given. And we can also measure profit with respect to the sales. How much of your sales become your profit? Let's say if you're doing sales of $100 a month and you get a profit of $1 against it, so that 1% may not be a very healthy figure. If you invest, if you do sales of $100 and you get a profit of 10%, so that 10% profitability becomes a very healthy and a very charming figure. Profitability measures. The income statement contains several figures that might be used in profitability analysis. In general, the primary function analysis of profit ratios should include only the types of income arising from the normal operations of the business. So when we talk about normal operations of the business, so we have discussed discontinued operations many times. Discontinued operation is an operation which you are only conducting in the existing or the present financial period. This operation will not be conducted in the next financial periods. So whenever we talk about profitability, we should always exclude the figures related to the discontinued operations. Similarly, we should always also exclude extraordinary items. Extraordinary items are those events uh, which are extraordinary in nature और उनकी occurrence reoccurrence की probability is very less. For example, XYZ Corporation had net income of 100,000 in year one and 150,000 in year two. Year two, however, included an extraordinary gain of 60,000. So when we do not exclude the extraordinary item, so we will say in year one the income was 100,000 and year two it was 150,000. So we can say that there was an increase of 60,000 in the net income. Uh, Sorry, there was an increase of 50,000 in the net income. However, if we exclude the extraordinary item, which led to a gain of $60,000, तो हम कहेंगे कि there was a dip in the profit. So whenever you talk about profitability, you should always exclude discontinued operations and extraordinary items from that profitability analysis. Now, the first ratio is called net profit margin. A commonly used profit measures is return on sales, often termed net profit margin. If a company reports that it earned 6% last year, this statistic usually means that its profit were 6% of sales. What is the formula? It is net profit margin is equal to net income. Obviously, you always exclude non-controlling interest, equity income, and non-recurring items from it, divided by net sales. This ratio gives a measure of net income dollars generated by each dollar of sales. What it shows कि when you do $1 worth of sales, so उससे आपका जो net income था, how much was it against the $1? Although it is desirable for this ratio to be high, competitive forces within an industry, economic conditions, use of debt financing, and operating characteristics such as high fixed costs will cause a net profit margin to vary between and within industries. Now, what does it mean? It means that if the market is very competitive and your competitors, they are trying to sell at a very low margin of profit, so since you have to compete with your competitors, obviously जो price up set करेंगे, that will have a very less margin of profit in it. So different factors can affect this net profit margin ratio. The net profit margin is equal to how much net income or profit is generated as a percentage of revenue. जितना आपकी revenue है, जितनी आपकी total sales हैं, उसमें what percentage of that total revenue was your profit. Net profit margin is the ratio of net profits to revenue for a company or business segment. Net profit margin is typically expressed as a percentage but can also be represented in decimal form. The net profit margin illustrates how much of each dollar is in revenue collected by a company into translates into profit. Exhibit 8.1 shows the net profit margin using 9 and 8 figures for Nike. This analysis shows that Nike's net profit margin declined materially but would still be considered high. Several refinements to the net profit margin can make it more accurate than the ratio computation in this book. When you refer other books or when you go on net, so you will find different formulas related to net profit margin. But for our analysis, we will be sticking to the formula that I have given above, which is net income divided by net sales. So now we look at the Nike figures for 9 and 8. आप देखेंगे 9 में it had a net income of $1468.7 million and the net sales were 10.176. Sorry, it was uh, $10,106.1 million. So how do you calculate the net profit margin? When you divide net income divided by net sales, and that comes in percentage. So this 7.75% means that for every $1 of sale that Nike did, it had a profit of 7.75% in it. Or we can say that for $1, since $1 is equal to 100 cents, so it had a profit of 7.75 cent against every $1 of sale that it did. The second definition is called total asset turnover. Total asset turnover measures the activity of the assets and the ability of the firm to generate sales through the use of assets. Compute total asset turnover as follows. Now, what does total asset turnover tell you? It says that the, the value of assets that you have employed to do your business. So, उस value से how much sales do you generate through the use of those assets? And that ratio is called total asset turnover. When we look at the figures for Nike, so हम देखेंगे उसकी 2009 में sales were 119,176.1. अच्छा, we take the uh, average total sales. So we look at the assets at the beginning of the year, end of the year assets, and then we calculate the average assets for the year, and then we divide it by we divide net sales by those average assets to get the total asset turnover ratio. Exhibit 8.3 shows total assets turnover for Nike for 9 and 8. The total asset turnover decreased from 1.61 to 1.49. This decrease would be considered to be moderate. The asset turnover ratio measures the value of a company's sales or revenues related to the value of its assets. The asset turnover ratio can be used as an indicator of the efficiency with which a company is using its assets to generate revenue. Obviously, if your total asset turnover ratio is less, it means the way that you are employing, the way that you are using your assets is not an efficient way to generate sales against it. The higher the asset turnover ratio, the more efficiency a company is at generating revenue from its um, assets. The third is called return on assets. Now आप देखेंगे second one was the total asset turnover had in it we were comparing net sales with average total assets. जो आपका return on assets है उसमें you compare the net income or the profit against the average total assets. Return on assets measures the firm's ability to utilize its assets to create profits by comparing profits with the assets that generate the profits. Compute the return on assets as follow. As I've already told you, जो assets होते हैं, assets का basically the aim of keeping assets is to do business through it. And when you do business, your aim is to earn profits. So you always acquire assets to increase your profitability. So we have to look at the fact, at the scenario that how much profit are we generating by employing those assets. So that we do through the ratio return on assets. Return on asset is an indicator of how profitable a company is relative to its total assets. ROA gives a manager, investor, or analyst an idea as to how efficient a company's management is at using its assets to generate earnings. Exhibit 8.4 shows 2009-2008 की फिगर शो करता है. Theoretically, the best average would be based on month-end figures which are not available to the outside world. Computing an average based on beginning and ending figures provides a rough approximation that does not consider the timing of interim changes in assets. Such changes might be related to seasonal factors. So how do we calculate the return on assets? You have the net income, and when you net income जो आपका total net profit है, when you divide it by your average total assets, you get return on assets. Now there is a term which was coined by a company. It's called Dupont return on assets. Now what is Dupont return on assets? Net profit margin, total asset turnover, and return on assets are usually reviewed together because of the direct influence that the net profit margin and total asset turnover have on return on assets. हमने अभी we have done these three ratios: total asset turnover, return on assets, and net profit margin. हमने we have done return on assets, total asset turnover, and net profit margin. When you combine all these three ratios and you try to analyze the performance using these three ratios, that is called Dupont return on assets. The Dupont analysis, also known as Dupont identity or Dupont model, is a framework for analyzing fundamental performance populated by the Dupont Corporation. DuPont analysis is a useful technique used to decompose the different drivers of return on equity. The decomposition of ROE allows investors to focus on key metrics of financial performance individually to identify strengths and weaknesses. Now, what is the formula for DuPont analysis? ये आपका, this is your one ratio, then your second ratio, and your third ratio. So in DuPont analysis, what you simply do, the ratios that that you have calculated, you analyze those ratios to calculate the DuPont analysis. So what is the ratio? It is return on assets is equal to net profit margin into total asset turnover. And when you use these three ratios to further analyze, you get a very good picture of how the company is uh, performing. For example, जो आपकी example one है, now it is this. You see year one में आप देखेंगे रिटर्न ऑन एसेट्स वाज 10%, नेट प्रॉफिट मार्जिन 5 है और टोटल एसेट टर्नओवर 2 है. Again in year 2, the net profit margin decreased by 1% while the total asset turnover increased by 0.5%. So what happened? How a more efficient use of assets can offset rising costs such as labor or material. जो आपका net profit margin था, it decreased because of your लेबर और मटेरियल कॉस्ट, लेकिन जो आपका एफिशिएंट यूज ऑफ एसेट्स था which we can see through the total asset turnover increase, so it can offset increase in labor or material cost. Now we look at another example to shows how a trend in return on assets can be better explained through the breakdown into two ratios. The two firms have identical return on asset. आप देखेंगे ये जो दोनों firms हैं, they have identical returns on asset, year one और year two दोनों में. Further, the analysis shows that firm A suffers from slowdown in asset turnover. When we look at firm A, the suffers from a slowdown in asset turnover. It is generating fewer sales for the assets invested. अब आप देखेंगे when we look at firm A, इसका return on assets 10% था in first year, and in second year it was 8%. Why it was 8%? क्योंकि उसका जो total asset turnover था, it decreased. Firm B suffers from a reduction in the net profit margin. It is generating less profit per dollar of sales. When we look at firm B, तो आप देखेंगे उसका जो total asset turnover था, it stayed the same. Its return on assets was the same, but its net profit margin decreased. So आप ये देखेंगे कि when you use DuPont analysis, it gives you a clear picture of why and how the company is suffering. Is it because of the net profit margin or is it because of the total asset turnover? So this is called DuPont return on asset. So this is the end of lecture number 23. Lecture number 24 and 25 may we will further discuss the profitability